Hello, everyone. I'm Dan Schleifer, the co-founder of ChartIQ and Technician. We're just letting people filter in. We'll get started in just a couple of minutes. Until then, if you have any questions or technical issues, send those over in the chat panel. Hello, everyone. Thanks for joining. I just wanted to let you know we're going to get started in just a couple minutes. We still have a bunch of people filtering in, so we'll get started in probably about 2 minutes. Thanks. Okay, well, thank you, everyone, for your patience while we got a little bit of extra time for people to get into the webinar. I just want to thank everybody for attending. My name is Dan Schleifer. I am the co-founder and CEO of ChartIQ and Technician. Today on our webinar, I'm joined by Lee Drogan of Estimize. He is on the line with us live from Fire Island, so you can see him out. Looks like playing basketball with 6-year-olds in the background at a very small hoop. Those of you who don't know, Lee is a little on the short side, so the small hoop is appropriate. Lee is the CEO and founder of Estimize. Estimize and ChartIQ have a long relationship, and Lee and I are personal friends. And today we're going to show off a really cool integration, which is Technician, our technical analysis and charting package, which, if you haven't tried it before, is available completely for free at technicianapp.com. There'll be links sent out, and I'm sure reminders and all that fun stuff. So it's our technical charting engine that you can access from your web browser, your tablet, or your smartphone, along with the incredible data set from Estimize, which is crowdsourced earnings estimates. And we have a package we call Visual Earnings, which, as the name would imply, allows us to visualize the data that comes from Estimize and really put it into context of what's happening with the price of a particular security and allow you to really see some interesting trends there as we bring together both fundamentals and technicals. With that, Lee, do you want to give just a little bit of an introduction and background on Estimize for those who might not know you?
Sure. Well, Dan, thanks for having me. It's great to have everybody. So Estimize was born out of the need for everybody to have a more accurate and, more importantly, more representative data set of estimates. You know, the problem that we've basically solved is that the sell-side data sets from Thomson Reuters, Bloomberg, FactSet, or CapIQ only come from those sell-side banks. Estimize is crowdsourced on our website, estimize.com. where all sorts of people, be they buy-side analysts, corporate finance professionals, industry experts, independent traders and investors, students, everybody contributes their estimates. They get to see the data after that, and our data set ends up being far more accurate than the IBIS or Bloomberg data, about 70% of the time. And more importantly, as I said, it's more representative of true expectations. So one of the things that we're going to show in the visual earnings package is what happens when a company beats the Wall Street numbers but misses the estimized numbers. And given that companies tend to beat the Wall Street numbers about 75% of the time on average, you would assume that they just don't represent true expectations in the market. And a lot of the time, a company will beat the Wall Street numbers, but it'll be down after earnings, and everybody will throw their hands up in the air and say, "Hey, like, why? This makes no sense." Well, it's because there was a number out there that they really needed to hit based on where the stock was trading today, and the price horizon feature on ChartIQ really kind of helps us understand that as well. So we'll go over both, and I hope you guys both sign up for the trial of the visual earnings, as well as contribute to the estimized data set eventually.
Awesome. Thanks, Lee. So what I'm going to do is I'm going to turn on screen sharing and show everybody Technician and some of the basics of visual earnings just from a mechanics standpoint so that everybody kind of knows what it is that we're looking at. And then we're going to take a few examples of some companies. We'll take a look at Disney to start with and really look at the data over at estimize.com, which you can go and look at, and of course you can contribute to the platform there. And then we'll come back into Technician and actually see that same data in visual earnings and go through a few examples. And Lee is going to be generous enough to kind of show off some of those trends and things that he was just chatting about before. So here we have Technician. For those of you guys who aren't familiar with it, I'm not going to give the full spiel. You can go and look at one of our other recorded webinars or just sign up for free and play around with it. But in short, full purpose, full function technical analysis suite that allows you to really go through and set up any sort of chart types you want, all different sorts of roughly 100 different technical indicators, drawing tools, chart types, etc. For today, we're just going to stick with how I have things set up on the screen with candlesticks so that we can see gaps around earnings. And I'm just including a simple 50-day moving average. So if you sign up for visual earnings or you sign up for a free trial by emailing us at support@technicianapp.com, you'll get a new menu here at the top of the screen called Visual Earnings. When you open this menu up, we have a few different options that I'm going to show you guys. The first is what we call the Miss Beat panel. So I'm going to open this up. I'm going to open it up with EPS. You can look at Miss Beat with earnings or with EPS. I'm going to go ahead and pull up, take a look at Alcoa. So here we can see kind of a dramatic example with Alcoa of the miss or the beats indicated by the large green bars. If we turn on our crosshairs, we can actually go down and see on the right axis where the real number came in and where the both estimized crowd and the Wall Street consensus were. We can kind of see the relative size of the beat. We can see bigger, big beat, medium beat, small beat, and then we can actually see quite the miss in this past quarter. So a very simple kind of trending indicator. I actually like to think of it as a way to look at fundamentals and look at the miss or beat of expectations, frankly, as a trending technical indicator. So, I often look at it on a long-term chart, and I'll often look at it even just like on a simple line chart showing the close, so I can see kind of what the overall trend has been of companies that either consistently miss or beat expectations, and how the market either rewards or punishes companies as that changes. Go ahead.
This is often very important for specifically momentum stocks, high growth names, where they continuously beat their Wall Street and, in our case, estimize expectations, which basically means that the analysts haven't quite factored that into the price of the stock yet, which often leads to further price appreciation and momentum in the future. And so my strategy when I used to run a hedge fund was largely centered around looking for situations where there was a significant row of beats or misses, and trading in that direction on kind of an intermediate term time frame, and then looking at what they would potentially do in the future. But it's often a very important indicator to future momentum, how many times in a row they beat in the past, or what were the magnitudes of those beats and misses.
Yeah, my favorite example of this was actually Apple back in the 2009, 2010 just kind of tear. And we're on such a small screen and kind of zoomed out quite a bit. But they simply beat expectations with only one small falter through this just massive bullish run and up into what ended up being the top. And we can see when they started to actually miss expectations a couple quarters in a row, and the ensuing crash that came after it. But we'll go into a couple of examples in just a minute. So the other thing that I want to show is what we call the data table, which is rather aptly named because it simply gives us the table of data of both actuals, the estimized consensus, and the Wall Street estimates for each quarter, as well as quarters coming up into the future. So we can see the expected earnings release date out in the future with these vertical lines, and we can see exactly what happened on release day. So if we follow release day down, we'll see actual earnings were at 233. The estimized consensus was 227, and the Wall Street was way behind at 219. We can also see things like quarter-on-quarter growth. So this quarter versus the same quarter a year ago, we can see annualized earnings, and then the price-to-earnings ratio it was trading at as of the day of the earnings release. So we can see all of that, as well as, of course, off into the future, what the estimized consensus is, what the Wall Street consensus is for each quarter out into the future. The next feature that I want to show, so again, just a way to kind of see the raw data, and you can go back in time and you can go off to the future. The next kind of aspect of visual earnings is what we call the price horizon. And what this does is, again, it plots the future estimated earnings release dates off into the future of the chart, and then shows a cloud-based distribution of earnings estimates based on what appears inside the Estimize platform. So what we do is we take, in this case, 3 quarters of actuals plus 1 quarter of estimates, and what the stock was trading at from a P/E ratio as of the last earnings date, and imply price targets based on that. This could be really interesting for a number of reasons. We'll go through a few examples later on. Sometimes it is simply amazingly predictive. When it's not, we actually have some really interesting mean reversion strategies. When we see something that's actually trading well below or well above what expectations are, we oftentimes see a mean reversion after that. So here you can actually see the Estimize and Wall Street consensus numbers, and then you'll see where the cloud kind of consolidates, and then you'll see some statistical outliers up here. Sometimes it's very interesting to see the outliers on the chart and whether the outliers all tend to be very bullish or all tend to be very bearish. The kind of overall trending with the crowd, but the ability to see the outliers itself I find really interesting. So with that, Lee, I know you wanted to, we're going to switch over to Estimize.com. We're actually going to use Disney as the example. I'm going to let Lee walk everybody through the Disney data over here.
Yeah, so I think there's a couple of important things to understand about how the data gets into the system and how it gets onto ChartIQ, the cleanliness of it, the accuracy, who's contributing, all of that. So what you're seeing here on the chart is a 9-quarter representation of Disney's EPS numbers. In gray there, those are the Wall Street numbers. In blue, those are the Estimized consensus numbers. In green, that's the actual reported numbers from the company. And then the different bands there, colored in blue and gray, are the ranges. If we go down the page, we can actually see all of the different analysts who have made estimates on the platform. So right now there are 25 different analysts for this quarter. We can see all of their names. Some of them are anonymous, and some of them are not anonymous. They've given their real names. You can also see some of their structured biographical information. As you can see, financial, professional, independent, and comes from an independent research shop. If we go back up, we can actually see some other visualizations of the data. If we click on the table, we can actually see it all in tabular format, very similar to the way you would see it on ChartIQ. High, low, guidance numbers if the company is given guidance, EPS and revenue. If we click on the scatter plot, we can actually see the full distribution of expectations, EPS by revenue. This is my favorite chart on the site because when you enter your own estimate, what you can see is basically where you sit in the distribution of expectations. And as a trader, what I really want to know is, am I really bullish, or am I kind of right inside of the consensus? Am I expecting what everybody else is expecting, or am I kind of really far outside of that? In which case, if I believe I'm going to be very accurate, which you make an estimate, you should, that you should take advantage of that situation. So this tends to be my favorite chart because it's a full representation of the expectation set. And then the last one on the right there is the change over time chart. So we can see how the consensus is moving over time throughout a quarter relative to the Wall Street consensus. And then your estimate will actually show up here. So you'll see how your estimate is moving throughout the quarter if you do edit your estimate. The top bar there is the estimate entry form. So if we go back to the historical chart there, and we move the EPS estimate entry by just clicking inside the box, and then up, you'll see that pink dot move. That's your estimate. You have to make both the EPS and the revenue estimate, and then you press Create Estimate. And as I said, you can edit it at any time. Now, the really important thing to kind of go over here is the fact that all of our data is validated by algorithms which make sure that the estimates that are put into the system are reliable. And when I say reliable, I mean there's no crazy outliers, there's nobody attempting to game the system, there's nobody attempting to move the consensus dramatically, multiple accounts, hurting, all sorts of cluster detection algorithms. So we've done a really thorough job in making sure that no matter who you are, we want your estimates in the system. We believe that they're incredibly valuable. It actually turns out that the non-professional half of our community is on average more accurate than the professional half. It has to do with some biases around which stocks they estimate on, given that non-professionals often have a view on only a few, and they have a very close view instead of a buy-side group that makes estimates on 60 or 70 stocks. But we make sure the data is incredibly clean, and it gets through an API, an automated protocol interface to the ChartIQ platform, and every time you pull up a new stock, it actually pulls all of our estimates in real time and does the calculations for the forward-looking price expectations on the ChartIQ platform. So everything is real time on ChartIQ.
Yep, and so as an example, here we are back on Technician showing Disney, and just as before, we were looking at the EPS data right now. Now we're actually seeing the EPS data. So if we pull up the data table, we'll see the exact same data. We'll see that off in the future with the price horizon. So you get to see all the same information in context of how the stock has been treated in the market itself. Now, Lee, were there a couple of example charts that you wanted to talk through?
Yeah, I mean, let's actually start with the Disney stuff. If we could pull up the EPS beat miss, that would be great. And actually, if you want to leave the price horizon stuff on there as well, because I think this is a great example too. So Disney is a significant reactor to earnings, and that's largely because there's not a lot of visibility into the business in between quarters. It's very kind of no information, all information. It also, Disney's a healthily growing company, and it's very interesting to kind of move back a couple of quarters and look at how the price has reacted to some big beats and then a couple of misses here on both the EPS and the revenue side. Again, this is a stock that if I was still running the fund that I used to run, that was kind of momentum, quantamental, Disney would have been a name that I would have most likely been invested in, given its recent history of significant beats, its revenue growth rate, and its margin expansion. And so the interesting thing to look at here is back in the March 14 report and then the June 14 report, we saw some big beats and the stock really got going there. Then in the fall quarter of 2014, we see a miss there on EPS and revenues. Now the interesting part is they beat the Wall Street estimate, but they missed the Estimized consensus. And the stock, really had a flat quarter there, even though the fundamentals, it was still growing well, but the sentiment around the stock had kind of dipped there. The next quarter, we see those big beats on both EPS and revenue, 2 quarters in a row, actually, and up the stock goes again. So it's very important to keep an eye on, how the company reported relative to its expectations, because there can be some significant post-earnings drift, not only in the following couple of days, but in over the course of the whole quarter. Now, the really interesting part about the price rising with Disney is what happened after last quarter. Now, you can see they beat the Wall Street expectations for revenue, but they missed Estimize, and they actually beat the Wall Street expectations for EPS, but they came right in line with the Estimize expectations, and the stock got crushed. There's an interesting, technical reason for that, and there's all sorts of other news that was associated with it. But when you boil it down, there was a very high, and the PE had expanded for Disney to a point where they had to hop over that hurdle, and they didn't. And we take a look at the price horizon there for next quarter, where the Estimized consensus says about $119 a share. Now, what's interesting about this is, based on the PE that Disney traded at after last quarter's results, it trades at a much lower PE today than it did then. So basically what it's saying is everybody on both Estimize and more Estimized than Wall Street, because the consensus is significantly above Wall Street, is basically saying the fundamentals of this company are healthy, they're going to continue to grow, but the market has taken the PE down. And so the decision as a trader that you have to make is, do I believe that they're going to revalue the PE higher in the future? Or is this going to be a PE that the stock kind of continues to trade at? And for something like Disney, where this seems like a one-quarter hiccup for them, I would bet that they revalue that multiple higher in the future after the next report. And so I would sit there and say, Disney is probably an undervalued stock here, given where the company is trading relative to its future price expectations based on the fundamentals. And there's a pretty good trade to be made there if you want to make a trade over kind of an intermediate term time frame. So this is one that I would definitely look out for. The other one on the Dan, what was the other stock that we wanted to take a look at for?
Gilead, I think.
Yeah, Gilead. So this is another great example of kind of the beat miss indicator, doing a really good job understanding when a company is going to see significant growth in the stock. So going back to April of 2014, we can see that big beat that really kicked off the whole run, and you saw some significant drift throughout the rest of the quarter. The next quarter as well, company beat on both top and bottom by a lot. Off we go, and this is even with the Estimized consensus being
55% movement. I mean, that 2 quarters. I mean, that's a that's a substantial run. It's kind of always sometimes hard to tell what the absolute values here are, but that's a 55-56% run over the course of those 2 quarters.
Yeah, and it's often that companies that really start to see significant beats or misses in their expectations after being relatively close to all the expectations in previous quarters, it really does get them going in one direction or the other, because what it basically signals is all of the people who own this stock and the Wall Street analysts, and in some cases the Estimize analysts, don't really understand the future power or negativity in the future earnings or revenue. And everybody has to revalue the stock for whatever those are going to be. We saw that in Apple, we saw it in Gilead, we saw it in Disney. So I think it's really interesting. On the price horizon side, Twitter is a really interesting stock for me, because I think it's another example of the fact that the market has really used a revenue multiple to value Twitter in the past. It's really not being valued at all on its EPS numbers. Now, Twitter obviously has a litany of other issues, But what's interesting to see here is that they continue to devalue the multiple that Twitter trades at based on its revenue numbers. And at some point, people are going to step in and sit there and say, look, Twitter's revenue growth is, what, plus 60% year over year on a quarterly basis now, the last couple of quarters, and we can see that on the data table. Yeah, so plus 60% still. A stock that trades plus 60% year-over-year growth on the revenue side, at some point that revenue multiple is going to get too cheap. And you're going to be able to see exactly how cheap it's getting by looking at that price horizon. And you can see, over the next couple of quarters, it expects that if you held the revenue multiple constant, and I think that it's starting to get kind of low for Twitter based on the growth. If you just held it constant, saying that they won't even revalue it, based on the expectations for revenue, the stock should trade at $41 after the February report. That's a pretty nice trade there if you're willing to hold for a quarter and a half here, and you believe that those revenue numbers can be hit, and they won't continue to revalue the multiple down, which I think is probably a pretty good bet here that they've revalued that multiple enough in the downward direction. So this is a really interesting one for me. I think Alibaba kind of fits in this category right now as well, with a multiple that's been significantly revalued downward over the last couple of months. And at some point it's going to get too cheap. It trades at a 23 times PE, and that's 32 times PE, and that's just getting pretty cheap for a company growing as quickly as it is.
Yeah, I mean, you see the PE just come down steadily, 60, 41, 40, 32, and that's based on earnings date, so it's definitely trading even lower now if we looked at today's PE. So you definitely have that, it does start to feel pretty cheap.
And this works in the other direction as well, obviously. There's been stocks in the past that have just, their PEs continue to climb. You can see it on the chart. You can see that the price horizon really gets flat, and there's really not much upside in that price horizon. And basically what that's saying is the company's kind of, run out of future growth according to the expectations, and that if they slip up at all, that PE is going to get revalued downwards, and it might be a great opportunity to short the stock with some tight stops above there, as we never want to let that go too fast with a momentum stock. But obviously, great opportunities to take advantage of PEs that have climbed way too high, or price to revenue that's climbed way too high compared to historical norms, and then play that mean reversion downwards.
Cool. Lee, were there any other charts that you wanted to take a look at?
I think the last one was Under Armour on the price horizon. This is an example of a stock whose PE has been very, very steady over the course of the last couple of years. It doesn't move around much, and I think stocks like this, which are growing very quickly, they give a really good opportunity to take a look at that price horizon and understand what the company is going to be worth with pretty good certainty, given that the PE hasn't moved around too much in the past. And so Under Armour trades at 101 now, but after the earnings report coming up after this one, which it's already kind of achieved the price target, it should trade at about a $1.15. And that's a pretty good trade. That's 15% in a quarter that you can make off of that trade if you don't believe that they're going to revalue the multiple. And I think historically, based on the way that Under Armour's traded, there should be no expectation that they will, especially given that the Estimize expectations are above Wall Street and they're normally far more accurate. So this would be a pretty good trade. And as a longer-term investor in Under Armour, this would also give me the confidence to say there's no reason why I should be exiting this stock at this point. It's just there's just no reason according to any of this stuff. So I think it's a great tool to use for the purpose of understanding the more static future PE expectations, but the growth in the underlying fundamentals.
Yeah, and I think to kind of recap, I think one of the things that that you pointed out is that, right, we do have always periods of PE expansion or contraction, and so the price horizon itself is built around this concept of assuming the market continues to value it in the way that it has. And so, you're able to really look at both the historical expansion or contraction of PE over time, as well as what your expectations are, and adjust up and down from there. And so, the nice thing is that it's laying out the data in a way that you can really put it into context. And depending on what your particular, thesis is, as far as the company, and most importantly, how the market looks at the company, really make some informed decisions on it. And this is, I'm really just kind of thrilled with Visual Earnings overall as a product, mostly because and I think Lee shares this with me, right, believe in both technicals and fundamentals, and that the way that the market reacts to the fundamentals of the company, manifests in the technicals and in the chart. And so the ability to see these things in context, for me, just paints a much broader picture of how the company is doing and how the market reacts to how the company is doing. So it's a really nice way to pull those together, and whether you're trying to kind of validate a thesis that you already have, try to understand historical behavior, or simply get a fresh look at a stock that you've been following for quite a while from either a fundamental model or from a technical perspective, it can be a really nice way to kind of pull those two worlds together, and develop, I think, a more robust trading plan for how you want to approach trading a particular stock. With that, I do want to be cognizant of people's time, and I know we're roughly hitting the 30-minute mark for the webinar, so people's attention will start to fade. Stephen, if we have any questions, please let me know. Otherwise, I'll just kind of remind everyone that you can sign up for Technician for free at technicianapp.com. However, Visual Earnings does cost money, but luckily only $29 a month. And you can sign up for that if you go to technicianapp.com and click on the marketplace. You'll actually see Visual Earnings available. It's actually the top of the list. And you can click to learn more and see just kind of a recorded video, a little bit more about it. We also have a tutorial as well as some examples on how to read the indicators that Lee and I were talking through today. And if you click Access Visual Earnings Toolkit, that'll give you your opportunity to put in your credit card information and purchase that for $29 a month. Stephen?
Yeah, Dan, I have a few questions here from throughout the webinar. A couple related specifically to Technician itself.
Okay.
About some of the options available. One question, do we have within our tool double exponential moving averages?
Double exponential moving averages. So I might have to check, because in all honesty, we have 7 different weighting mechanisms for the moving average. So if you pull up a moving average, you can obviously change your look back period, which field you want to put it on. So if you want to put a moving average on RSI, so we've got exponential, time series, triangular, variable, weighted, Wells-Wilder. I don't see double in here, but I would have to check if one of these is kind of an AKA for that. But if that's something that's important to you, moving averages are really easy for us to add. You can always send that request to support@technicianapp.com.
And similarly, do we plan on adding ROE and PTM within the app?
ROV and PTM. I'm not sure. Lee, do you know what those acronyms are?
I think ROE is an oscillator, but I can't tell you exactly what it does, and I have no clue what PTM is.
So I put up on screen all the different kind of technical indicators that we offer. So these are the ones we usually add. A handful of new ones every quarter, sometimes more. Roughly, it's about 100 different indicators that we offer right now. So take a look through the list. Obviously, you can sign up for Technician for free and play around. If there are particular technical studies or indicators that you're looking for, please do shoot us a note.
We did get an answer, return on equity and pre-tax margins. I don't know.
Oh, I see. Fundamental data. So, it's an interesting thing. We are actually looking at adding a broader set of economic indicators, both fundamentals of a particular company as well as macroeconomic data. So that is something that we're actively looking into, so that you can plot those along with the earnings data. So that is something that we are actively working on.
All right, a couple questions that we had some folks at Estimize answer, but I wanted to repeat out there so everyone heard the answer. One was a question about how quickly do the earnings results post to Estimize into the charts, to which Gavin over at Estimize replied that Estimize sources data from Benzinga, who usually posts within 15 minutes of the release time.
Yeah, they'll vary, obviously. One of the great parts about Benzinga is they do a very thorough job of making sure that all the accounting standards are match. That's actually something that Bloomberg, Thomson Reuters, FactSet, CapIQ often won't do. They'll often get whatever number is in the press release up there right away, but that's obviously problematic for a platform like ours because we score and rank every analyst who makes an estimate on every release, and we need the right numbers the first time. So Benzinga sometimes will take their time calling an analyst or looking through the document and making sure that if something looks a little weird that they eventually get the correct apples to apples number in there. But I would say on average it's within a few minutes, and sometimes it's immediately. And then at the most, it ends up being 15 to 30 minutes later.
And I would just comment, much like Estimize is more accurate than the Wall Street consensus 70% of the time, Benzinga has actually proven to be far more accurate than Thomson and Bloomberg. I happen to know this only because we work with a couple of very large brokerages here in the U.S. I happen to know of some evaluations they've been put through recently, and we're actually shown to be the most accurate source of actual earnings data. Again, blew my mind that there was inaccurate actuals out there because I just didn't know the process there. But it turns out that there is a lot of errant data out there. It may later get corrected, but you want to trade off of the most accurate data that you can. So Benzinga is a great source for that.
All right, another question that the Estimize team answered that I'd like to repeat. Can we get other estimates for Estimize besides earnings, like oil inventory reports?
Yes, so on Estimize, you can get 25 different domestic economic indicators, including oil inventories and the report. If we go to economics there, you can see the list of all of those different reports. I know that Dan and I have obviously discussed adding the Estimize economic stuff as another kind of visual economics package to the ChartIQ platform. So that's something that we'll probably endeavor to get into pretty soon.
Absolutely, I'd love to get it in there and allow people who are either trading commodity futures or FX or other asset classes and have their own particular dependencies and interactions between macro data and tradable assets.
Last question we have here, and we still have the floor open for other questions. I'll keep an eye out in the chat. But there's a question about what the price actually means. So we're talking about Disney. Does that mean that the price will be at 125, for example, around the earnings, or is that after the earnings?
Oh, that's a great question. So the implication of the price horizon, again, it's up to your interpretation of whether or not you believe that the market is going to continue to value it at the PE that it has in the past. So we just run the numbers through the algorithm. We're not personally making predictions or advisory, but that after earnings announcement. So this would, looking at Disney, factor in that the expectations of Estimize actually pan out, right? That the Estimize crowd is correct. If you think that Estimize and or Wall Street are too bearish, then you would expect the price to be above that after earnings release. If you think they're too bullish, you would expect it to be below that after earnings release.
Yep.
And for, as I think we mentioned before, but just in case, you can turn on the price horizon for either revenue or EPS, and they will be different. And obviously, some companies trade more off of one than the other. So it is important to remember which price horizon you're looking at, and how, whether that company tends to trade off of earnings or revenue.
All right. One more question just came in. Any European stocks in the charts, specifically VW, which is a timely question.
So we do have some ADRs, some European ADRs. VW, I don't believe, is one of them on the platform right now. We're going to be expanding to international equity data sets at some point over the next couple of years. And VW certainly would be one of those where the price horizon would be showing a significant upside, given that the multiple has just been absolutely slaughtered the last couple of days for good reason. But yes, I would say within the next year and a half to 2 years, European stuff will end up getting onto Estimize.
And in Technician, generally, we do have, so as you go through and search for a particular security, you will find international equities. You can also filter down just stocks, FX indices, etc. And so something like Volkswagen that actually trades on multiple exchanges, you will see each of the exchanges that it trades on and can switch to that data. And as Lee and team have earnings data for those particular international securities, that will automatically get added. And I will agree with everybody that that is a brutal-looking chart.
Gosh. One final question here, and probably a good way to wrap up and reiterate what we've been talking about. But how do you come up with the estimated future quote, and how do you estimate the P&E?
I'm sorry, could you repeat that question?
How do you come up with the estimated future quote?
Oh, so the price horizon. Mm-hmm. So the way that works, let me pull Disney back up. We'll take a look at the price horizon. So the way that this works is that we take into account the past 3 earnings releases, so we know what actual EPS was for 3 quarters, and we know what the estimated EPS is for the upcoming quarter release. So now we have a full year of earnings data. And we simply take that and are multiplying it by the PE ratio that the market gave it at as of the release of the most recent earnings. So that's, it's a very straightforward algorithm. We've played around with, kind of acceleration and deceleration of PE expansion and contraction, but in the end, we find that this gives people the most stable kind of understanding of how these targets are calculated. And as we discussed before, if you think that PE contraction is going to continue, or you think that PE expansion is going to accelerate, you can kind of factor that in into where your own price targets would come in.
I think we might have lost Tan. Oh, there we go.
Am I still here?
Yep, now we got you back.
Okay. Well, hopefully you caught the answer to that. If you didn't, email us. We'll send you a full answer. I don't want to be repetitious for everybody else. But that's kind of how we calculate things. Well, listen, everybody, I really appreciate you you taking the time to dial in. Hopefully you'll sign up for Technician and give it a try. You can sign up for Visual Earnings, like I said, from the website, $29 a month. If you would like a free trial of Visual Earnings, send an email to support@technicianapp.com indicating that you would like a free trial of Visual Earnings, and we'll go ahead and set you up for that. Or like I said, it's only $29. I do highly recommend trying it out for a month or two and really learning about how to use it. If you go to technicianapp.com and you go into the Resources Center, we have a much deeper explanation of how to read all the indicators than what you saw today. And Lee and myself are always available for anybody that has questions.
Well, thanks for having me, Jen.
Absolutely. Thanks for joining, Lee.